Welcome to today's What Moved the Market show. I'm your host Prem. It's Friday, January 9th, 2026, and here is everything you need to know as the markets close for today. Day's market performance summary. Indian equity benchmarks extended their losing streak to a fifth consecutive session, with the Nifty 50 tumbling 0.75% to close at 25,683. The Sensex fared slightly better, but still fell 0.72%, ending at 83,576. BankNifty weakened as well, settling at 59,251. This retreat marked a challenging week for Indian investors, as both indices snapped a two-week winning streak, with markets surrendering about 2.5% over the past 5 trading days. The rupee showed signs of weakness too, trading at 90.17 against the US dollar, up 0.33% from the previous session. The real story behind today's decline is not just the numbers, but the mounting geopolitical and trade uncertainties that have weighed heavily on investor sentiment throughout the day. Persistent selling by foreign institutional investors, who offloaded over 8,000 crore rupees just this month, combined with lingering concerns over US tariff policies toward India, created a perfect storm of negativity. Top gainers and losers. Today's movers painted a clear picture of market defensiveness. Adani Enterprises led the declines with a fall of 2.59%, followed closely by NTPC, which dropped 2.29%, Adani Ports fell 2.1%, and ICICI Bank slipped 2.09%. Geo Financial Services also saw selling pressure, closing down 2.04%. On the bright side, Asian Paints bucked the trend with a gain of 1.88%, driven by stronger consumer confidence in the paint sector. ONGC climbed 1.16% as oil prices remain supported by geopolitical concerns. HCL Technologies added 0.94%, while Bharat Electronics and Dr. Reddy's Laboratories each gained 0.55 and 0.50% respectively. A notable casualty was Elecon Engineering, which crashed a stunning 16% after reporting sharply disappointing quarterly results. The company's net profit plummeted 33% year-on-year to 72 crore rupees, while its EBITDA margin compressed by over 23% due to delayed order inflows in its core gear division and higher employee costs. Sector performance and market leadership. Broader indices also showed weakness, with the Nifty Midcap index shedding 0.79% and the Nifty Smallcap index falling 1.81%. Real estate proved to be the day's biggest sectoral loser, with Nifty Realty plunging 2.26%, as investors fled consumer discretionary bets amid economic uncertainty. Auto stocks, consumer durables, and FMCG companies also weakened by 1 to 1.15% each. Pharmaceuticals dropped 0.85%. Only oil and gas, IT, and PSU bank sectors managed to close in green, gaining between 0.18 and 0.4%. Support and resistance levels recap. From a technical standpoint, Nifty 50 tested critical support at the 25,700 level, but managed to hold above it on a closing basis. The index formed a bearish candle for the second consecutive session with lower highs and lower lows, signaling sustained weakness. Key support levels now rest at 25,600 and 25,500, with a decisive break below 25,500, potentially opening the door to further declines toward 25,400 and 25,250. On the upside, resistance emerges at 26,000, where supply pressure remains concentrated. Regulatory, policy and macro updates. On the policy front, the markets have been keenly awaiting the US Supreme Court's decision on Trump's tariff regime. However, the court delayed its ruling, leaving India's export sectors in limbo. With $8.3 billion of India's annual exports remaining exposed to Section 232 national security tariffs and the possibility of additional 500% levies on countries buying Russian oil looming, the uncertainty is particularly acute. India's dependence on the US market is significantly higher in tariff-sensitive categories like automobiles, steel, and aluminium than in the broader export basket, making any adverse ruling a potential drag on earnings for major exporters. Domestically, SEBI's recent revisions to futures and options trading rules, which introduced new lot sizes effective January 2026 and stricter margin requirements to curb excessive speculation, have largely been absorbed by the market. Commodity market summary. The commodity complex showed a contrasting narrative today. Gold rebounded strongly, with MCX Gold prices climbing 0.41% to settle at 138,490 rupees per 10 grams, gaining 560 rupees from the previous close. This rebound reflects traditional safe haven demand amid geopolitical tensions. Silver also recovered, trading near 254,500 rupees per kilogram, posting significant intraday gains of over 1.6% as investors sought shelter in precious metals. Crude oil prices moved higher, with WTI reaching $62.14 per barrel, up from $61.45, driven partly by concerns over supply disruptions from geopolitical events in Venezuela and the Middle East. Brent crude also climbed 0.8% to $62.49 per barrel. Geopolitical events and market impact. The U.S. Supreme Court's delayed ruling on the legality of Trump's so-called Liberation Day tariffs left markets in a state of flux, as investors grappled with the possibility of sweeping import duties that could severely impact India's trade prospects. Beyond tariffs, deeper geopolitical tensions surrounding Venezuela, where the U.S. has asserted control over oil reserves, alongside escalating diplomatic standoffs over Greenland and persistent instability in Iran, have collectively dampened appetite for risk assets. Technical outlook and forward view. BankNifty, which closed at 59,251, is similarly trapped in a corrective phase. Immediate support sits at 59,500 and 59,250, while resistance is placed at 60,000 and 60,250. As long as BankNifty trades below the 60,000 mark, the bias remains cautious and defensive. Looking ahead to tomorrow and beyond, markets remain in consolidation and correction mode. The technical setup suggests a range-bound to mildly bearish bias unless there is a sharp positive catalyst or unexpected news flow. Gift Nifty futures, which trade overnight in Gift City, will provide early signals of sentiment for Monday's session. For day traders, the 25,700 to 26,100 band will serve as the key battleground. A decisive move above 26,000 could trigger short covering rallies, while a sustained break below 25,600 would indicate capitulation and potentially accelerate declines. Actionable takeaway and sign-off. Given the persistent FII selling, which shows no signs of abating despite DII support, investors should remain vigilant and maintain a defensive posture. Quality large-cap stocks and dividend-paying securities may provide some stability, while highly volatile mid- and small-cap names should be approached with caution. The earnings season is in full swing, and company-specific actions will likely dominate stock performances despite the broader index weakness. Key takeaway for today and the week ahead is simple but crucial. The confluence of external pressures, U.S. tariff uncertainty, geopolitical tensions, and dollar strength, combined with domestic selling by foreign investors, has created a perfect storm that neither good earnings nor strong fundamentals can easily offset in the near term. The real opportunity emerges once these macro uncertainties get resolved and markets find a bottom. Until then, position sizing, risk management, and stock selection are paramount. Protect your downside first, and the upside will take care of itself. Thank you for tuning into today's What Moved the Market. This has been Prem with your evening market wrap. Send in your questions, market observations, and stock picks to our email. And do stay tuned for tomorrow morning's detailed opening analysis, where we will break down any overnight developments and chart the course for the trading day ahead. Have a great weekend, and we'll catch up with you first thing Monday morning.